all small businesses, right? And if if it's your company, probably at that time it's 0. And then if you hold it for 5 years and then you sell it either through IPO or either to sell to investors, you get capital gain tax free. So the exemption is the greater of $10 million or 10 times adjusted basis. So your adjusted basis, most of you guys, entrepreneurs, founders, your adjusted basis is 0, right? It's just your sweat. So you take $10 million. Okay, so we're talking about with the new tax law, $4 million federal tax saved. Okay, now the California does not recognize this. So I tell my clients, if you really think, in the next 2 years, you will have a liquidation event, we're going to establish a domicile residency, create a trust, and then also buy a home in Nevada or somewhere they don't have 13.3% tax, right? So you save another $1 million state tax. And this is very important. The way you can do it is say if you are a small business, let's put this together after a little bit, after we talk all of these. So when you have, let me just first back up a little bit. So there are, in terms of investment, there are 3 areas. 3 areas you can be taxed. One is the seed, then is the growth, then is the harvest. So for 1K, the seed is free, right? The seed is tax deductible. Captive insurance, the seed is free. The charitable contributions like a donor advised fund, the seed is free, okay? So the growth, again, all IRA, the growth is free. HSA, the growth is free as well. And now, the harvest, 401k, the harvest is not free. These are taxable income. Roth IRA, the harvest is free, right? So here, now Roth IRA is only this much Roth IRA, $6,000 a year. And then yes, you can do conversion, Roth IRA conversion, that increase, but still not much. So if you are, say you have a liquidation and you have $10 million, $20 million, now how do you invest? So this qualified opportunity zone fund, if you put money in there, the first 5 years, you can actually defer your capital gain tax. And then actually if you sell it within 10, or then, so after 5 years, your capital gain tax is reduced by 10%. And after 7 years, reduced by 15%. Now, the beauty is if you put the money in there in the opportunity zone fund, 10 years later, if you sell it, you are completely exempt from any capital gain tax. Now, that actually makes a huge difference. If we put $1 million there at 10%, if I hold 10 years, the difference is $700,000, right? So actually, that's where you save the tax and it'll make a huge difference. Now, these are not difficult to have. There are opportunity zones everywhere, and then there are opportunity zone funds everywhere. I actually started one. I want to help my clients. Really, we can be creative. We can have rent a virtual office there. And nowadays everybody's working at home anyway, right? So you have a virtual office. You have a location there, and you can qualify as an opportunity zone business. So for entrepreneurs, if you want to attract more investors, this is something you can easily do. And there are a lot of opportunity zones in LA, in South Bay. So that's one example of a tax-free money that you can earn, right? So the next one I want to get into deductions, how you can take advantage of all the deductions, adjustments, and tax credits. So my favorite tax credit is R&D tax credit. So here's the thing, Amazon, they have loss. How many years? Over 20 years, it's all loss, right? They do not, and people don't understand why Amazon, looks like such a great profitable business dominating the market. Why are they not paying tax? Well, they really don't have income. They don't have net income because they all use the money, they invested in the business. And even better, the government is paying them part of that money for the investment. So anything related to business, to the R&D, your salary is 100% qualified. And then if even it's a contractor, 65% is qualified. And then of course, other supplies. So the federal government will give you 10% of your expenses as a tax credit, which means if you spend $1 million on R&D, the government will give you $100,000 tax credit. And if you're in California, that's even better. California give about 5% again. So you get $150,000 back from the federal and the state government. And then now this tax credit is used to reduce your income tax. Now, if you don't have income tax, if you are a small business, qualified startup, which means in the past 5 years, your revenue, your average annual revenue hasn't exceeded 5 million yet. You can actually use this tax credit to reduce your payroll tax, even if you don't have income tax yet. And then here, when you have very good profits in your business, you can always put money away. Everybody understands the 401k, right? So you can actually put quite money away along with 401k, defined benefit plan, cash balance, aggregate benefit plan, profit sharing, all of these. You can put away quite some money, okay, quite some money. So in this case, you have $160,000, $130 salaries, and as an S Corp, $290,000 S Corp, the K1 is still $1 million. So your taxable income is $1.2 million. So your tax exposure is $500,000. So after tax net income is $700,000. So by putting $24,000 into your 401k, and then you put defined benefit plan and aggregated benefit plan, profit sharing, we can put $1 million deferred there, okay? Now here, people will question, how can you put so much money in there? Even defined benefit plan is $200,000-ish. And even if you, increase more, with your actuary, maybe $400,000, how can you put $1 million there? So there's a little bit of secret that people don't understand. It's called 41H. Now, 41H, H stands for health, which means you put money there. It's almost like a self-insurance. You put money in there, and then when you retire, you use this money for health purpose. Now, and sometimes the people scared, okay, that's restricted. Well, tell me which is not related to health, right? What expense is not related to health? So it's really, don't worry about how you use it. You can reduce tax significantly. So this way your taxable income is only $100,000, $180,000. Your tax is only $50,000. So you save a $500,000 tax, okay, just by doing this, taking advantage of an adjustment you can take. And then this is true for like a captive insurance, for example. You can put $2.3 million away for captive insurance to self-insure yourself. And then the capital insurance can grow as an investment offshore. Okay, so that's another diversification. And the same theory for for the charitable strategies. And then Esop, I love Esop. Esop is really a great way for a private company to reduce tax because the contributions are tax deductible to the Esop trust. And then you can also use it as a financing source. So you can use the Esop stocks and go to the bank and say, hey, look, we have this Esop, and we can borrow money from you for the employees to buy stocks. So it's, in a way, it's an internal IPO, right? So it's a financial source. And then also it's an exit strategy. You can gradually sell your stocks to your employees. So it's a good succession plan as well. And then if your company is 30% owned by your ESOP, you can also get a very good capital gain tax exemption when you sell your business. So this one is really a good, you can retain your employees and build a culture of ownership, and then also save tax along the way. So captive insurance. So when your business gets very profitable, say $2 million, $3 million, and say if you're a C Corp and you don't want to pay tax, so what you do? So one big strategy is captive insurance. So you basically say, instead of buying insurance from Blue Cross for health, buying and other insurance companies for professional liability or for product liability, cyber attack, earthquake, whatever you name it. So you say, I'm going to self-insure myself. Okay, so you basically now paying your insurance company a premium up to $2.3 million. These are all deductible. These are all your expense, insurance expense. And then the money now goes to your insurance company. And this insurance company could be offshore, Bermuda, like that. And then you use the money to invest. We partner with a company. They do a very innovative strategy using both the captive insurance and the reinsurance, so that reduce the cost significantly and also have the leverage. So also when you have quite some money, right? One way I like is a donor advised fund. This is basically like the itemized deduction, the charitable contribution. So charitable contribution, you have to find a charitable organization and you put the money in there, you give them, and then the money is gone. So donor advised fund, you can open a donor advised fund without any cost at Fidelity, Charitable, Vanguard, Charitable, and then you put the money in there. The beauty is now this seed is sheltered, and the growth is sheltered, and the use is also sheltered. Okay. Now the donor advised fund, it's really good for your planning because you may not know what charity you want to create or what charity you're passionate about. Okay, so you put it into the donor advised fund. It's really a irrevocable trust. So now you just manage it and you invest it and let the fund grow. However, you take the full deduction when you put it into there. And then even better, if instead of putting cash, you put appreciated stocks in there, appreciated assets, any appreciated assets in there, you don't even have to pay capital gain tax for the appreciation. Okay, that's even better. Now, the donor advised fund, you can use some, ask me, okay, then it's, the money is gone, the money is gone. The beauty here is you do not own it anymore. It's irrevocable trust, but you have full control. You have full control, and you can donate it to whoever you want to donate. So eventually, if something you're passionate about, whether it's related to education, whether it's related to youth, senior care, take care of your community or parks, anything that you are passionate about, right? You can choose. You can create a charity, and as long as you cross the T's and dot the I's, right? You have a, instead of you yourself being the founder and the board of director, you know, you have a friend that become a board of director, somebody become a treasurer, right? You have some internal control. So this is not just your own, it's a public charity, but you have full control. You can use the charity's money. You can build, you know, you can buy a resort and say this is a retreat center for education. You can use it, right? You can, you know, I even say you can buy a yacht, right? You use it for training, for education, right? So it's all about the context, all about the story, how you create it. So, and then you can use charitable remainder trust. So charitable remainder trust, like donor advised fund, you are putting your appreciated asset into the trust. This way, you do not have to pay capital gain tax. And then you can receive income. You can still receive income while you're alive for yourself or for your children. And when you pass away, the remainder goes to charity. Now, when you donate this money to the trust, you get a tax write-off in the itemized deduction section as a charitable contribution. Okay, so that's the beauty. You know, how you do not have to pay tax, but you can increase. Really, if you look at it, it's all yours. It's your family foundation. And that person, as I said, the person who received the money could be yourself or could be a beneficiary. Now, this gets very interesting. You can create a life insurance trust, okay, called a ILIT, Life Insurance, Irrevocable Life Insurance Trust. Now this income is gonna leverage, you can buy a life insurance. So the beauty of here is now, you know, you part of the income goes to a life insurance trust and eventually pass to your children. Now with that said, that becomes very exciting. So this is an example of this planning. This is with planning, you know, this is the assets that are going to pass on children without life insurance. This line is the assets that will not only pass your children, but also you can use in lifetime, right? So suddenly it becomes much bigger, and the longer time horizon you have, the larger it has. So life insurance, again, we're using the leverage here. So how life insurance works, how you leverage it. So here you have, you know, you pay a minimum premium to cover your death benefit. And then anything above, it's going to be invested. So over time, you have a cash value. You have, and this cash value is a tax-free income. And this chart, Josh, one of my specialists, I partner with specialists, one of the specialists I partner with, he created this chart for me, and it's so simple. This is like, oh, this is the first time I understand. This is so-called whole life insurance or universal life insurance, cash value life insurance. That's what it is. So now we can actually make this life insurance strategy even better. So through premium financing, again, remember we try to leverage as much as possible. Okay, so here it's called premium financing. So the premium financing basically is you have a bank, you borrow the premium from the bank, and you pay the interest only. Okay, so the bank is paying the premium for you, and then you share the benefit. So you need to, hold on one second. So it does require some qualification. You need to have an annual income of $250,000 and net worth of $5 million. Okay, so that I know some of you here are my clients and you already qualify. So let's look into that. This is actually a very, very good deal. Once you qualify, all I need is to issue a asset verification from the CPA. So, this is something I can do easily. And then you go to the bank and tell them, hey, this is what I'm going to do. And, they'll fund you, okay? So this is how it works. Basically, the premium is paid by the bank. And then you share, this is simplified. This is not the whole policy is going to the bank. But here, the death benefit, when you die, portion of the death benefit will go to pay off the principal of the loan, okay? And then here, because of this premium you pay, portion is going to the minimum insurance and a portion is going to the investment. So your investment is growing. Now the only cost to you is the interest of the premium. Okay, this is it's the derivative of the interest. So it's much lower. So instead of say $1,000 a month premium, now you're paying 5% of $1,000. Thinking this way, right? So this is really paying a little money and you leverage a larger value. So I'd say this is a life insurance at a steroid. It's make it even better. So that's a very, very good leverage. So if you qualify, if you have more than $5 million net assets and more than $250,000 cash value, do it as soon as possible. This is no-brainer. Okay. So we talk about the charitable remainder trust. So the charitable leader trust is actually similar, but it's a reverse. So the charitable remainder trust, you receive these income, and then you pay the remainder to the charitable to the charity. Now here, charitable leader trust is you actually at the end of the term, you get the remainder. Okay. Now, during the term, you will pay a portion of income to the charity, and also put a portion of income to yourself as well. Okay. And then when you fund it, you get a deduction for tax. So that's the beauty. And then again, your thinking is very important. If you really start to think, the beneficial charity could be your donor advised fund. Now the donor advised fund, again, it's invested. You can grow the fund again, right? And it's under your control. So it's getting even more interesting, give you more leeways. So now I want to talk to the third one. So the third one is really a lead to shift your tax liability to other entities, whether to your children, to your parents, to your offshore entity, to your related entity, or to your C Corp, S Corp between each other, LLC, your trust, right? And then in terms of shifting years, you can shift your future, or you carry forward, carry backward all of these strategies you can use. So one example here is the 1031. So the 1031 exchange is for real estate investors. So here's the example how it works. So if you sell a real estate with $500,000 net, if you do not do a 1031 exchange, you're paying $141,000 tax. And this is still based on the older rate. I'm not talking about the 40%, okay? I'm still talking about the 33%. And then the depreciation is 25%. I'm still talking about the 23%, okay? The 3.8% is for net investment income tax. So you only have $358,000 left. And if you put into a CD or something, your annual income is only $10,000. But if you do an exchange and the purpose of doing exchange is actually to capitalize your equity. You release your equity so that you borrow money and you buy a bigger investment. When you fully invest, you get a $40,000 annual income, so 4 times more. So you see the numbers. So now this one probably is going to go away. Probably will go away. Okay, this is on the agenda to repeal. So if you repeal, one thing you can do, you sell it now. Most likely, even if they pass the law, most likely they're not going to go backward. So 2021, most likely you'll be fine. If it's going to be effective 2022. So 2021, you can leverage it and you can do an exchange, and this is good. And then in the future, you probably the good strategy to release your equity is to borrow, just to refinance, to borrow. And of course, it's difficult for you to refinance every 3-4 years. But there's a loan called all-in-one loan. It's the combination of your checking account and your home equity line. And then the home equity line, they give you up to 80% of the equity. So your equity increases, the line also increases. So you can take this money out and you can use it for investment, whether it's to buy life insurance or to invest in starting your business. So that's how you can leverage your equity in your real estate. So people ask me, whether it's S Corp or whether C Corp. So let's start with the S Corp. So one thing I always say is, if you are a professional, you're just starting, just graduating from graduate school, now start to work, you're making $70,000 a year. What do you do? If you don't do anything, well, you probably pay 20% of tax. You're paying probably $10,000 tax away. So you can do something to completely eliminate tax. One thing I always say is maximize your 401k in your company. So maximize $24,500. That reduces probably your tax for $5,000 right away. And then max your traditional IRA, $6,000 if you're married, and then max your HSA, $7,100. Okay, so it's give you another $13,000 deduction, another, let's say 20%, another $2,000-3,000 tax saving. Okay, now you probably still have to pay $2,000 tax. Now, one thing you can do is you have a Schedule C, have a small business. Now you say, hey, I don't have a small business. Well, business, all you need is to have something you intend to make a profit. So you start a Schedule C, sole proprietor, because you are professional, whether it's a computer science, whether it's a, whatever design or artist. You started this with the intention that you will make money. You start to research, you started to educate yourself, prepare everything, and start to call people. Okay, now you can at least write off your cell phone, your car. We're talking about easily $5,000, as long as it's reasonable, right? If you make $70,000 and you write off $5,000 small business, I think it's reasonable, okay? So now you, again, by that time, you probably don't have to pay any tax, okay? You probably eliminated your whole $10,000 tax. Now you, over the years, 2-3 years passed, and you actually start to do some side gig and start to make some money, and you are making $50,000. Here is a time you have to pay self-employment tax, so $50,000 net. Let's say $50,000 net, okay? So you say you make a $70,000, after all the deductions, cell phone, travel, car, dinner. Now you have $50,000. That means you have to pay $50,000 times 15% self-employment tax. Okay, so you're paying, 50,000 times 15%. How much is $75,000? $7,500. So you have to pay the self-employment tax, and on top of that, your profit you still have to pay income tax. Okay, so that's where the S Corp come. So the S Corp is basically says, okay, $50,000. Instead of paying $50,000 times 15% self-employment tax, we're going to do this. We're going to pay yourself a reasonable salary. Okay, let's say pay yourself $10,000. So now we pay self-employment tax based on $10,000. $10,000 times 15%. That's $1,500. Okay, so you saved $6,000 right away this way. Okay, so that's where the S Corp comes in. Now the S Corp, you continue to grow, and then right now you also get a nice 20% business deduction. Okay, so if you have a business income of $100, you get a deduction $20. So your you only pay based on 80%. Okay, so your real tax rate is only 19% versus the C Corp, you are paying 21%. And then if you move the dividend to your person, you still have to pay tax. So the tax rate is much higher. Okay, so that's now. Now, people ask me all the time, C Corp or S Corp, and most people say S Corp because of this. I agree, especially if you are in a service business, it's not scalable, right? You're gonna, you needed the money to use for your life. So you have to distribute everything, right? So on the other hand, if you are in a place where you have other income and now you're starting a venture and you're seeing your venture is going to be scalable, okay? Or if your S Corp is so much, after paying all your expenses in the S Corp and also paying your salary, you have plenty of money to live. I say convert to C Corp. Now you say, why convert to C Corp? Well, you have to pay double tax. Not really. As long as you don't distribute a dividend, you don't have to pay this tax, right? You only pay this tax. Now, even better, the C Corp, you have so many ways to put your fringe benefit in there. For example, you can create a group life insurance, and then part of the premium is deductible as expense, and then you benefit it. And the life insurance, again, you can take money, borrow money out, it's all tax-free, right? So the C Corp, again, as we talked, there are so many ways you can reduce the income to almost zero so that this tax rate is irrelevant, right? The captive insurance, 2.3 million, you have all the defined benefit plan, you put $1 million in there. You look, even $3 million, you don't have to pay tax, right? So, and then plus you can create an education assistance program for yourself, for your children, pay your children. You can create a medical reimbursement plan, a lot of things, a lot of employee benefit plan, all can go to the C Corp and you don't have to pay tax. And then again, the best is if you still have money, use technology and build up your business, build up your employees and build up your systems, and then apply for the R&D tax credit, let the government pay you. And then the money you make is when you have a liquidation event. And at that time, again, you get $10 million capital gain tax-free capital gain, right? So looking at the big picture, the C Corp has a lot of advantages there. So when you plan, really, as I said, if you are young and you're starting and you really get this to design a plan for your 10 years, you maximize the 401k, maximize a traditional IRA, maximize a HSA, so you don't pay any tax. And then you have a C Corp, have a schedule C, you deduct something, you don't pay any tax. And then gradually your C Corp start to make money, side gig grows. And then now you probably talk to your employer, say, hey, let me, work with you as an independent contractor, which now you in the name of your S Corp. And you tell your employer, hey, I can do the same job, even more efficient because now I have assistance. You will save money because you don't have to pay payroll tax anymore. You still pay me the same, right? So your S Corp start to come. And now your S Corp is your company. You can do whatever you want. You can create your 401k in your S Corp. You can create a defined benefit plan. You can create, when you make a lot of money, do a captive insurance, all of these. And then when it grows, it's really looks like it's scalable. You can sell it, sell stocks, or you can go IPO, convert it to C Corp. Convert it to C Corp, and then really play the bigger game and aiming to make the $10 million above capital gain tax, capital gain tax-free capital gain on the sale of your business, right? That is a big picture. That is very interesting, okay? And that is very possible. As a professional, we have a lot of opportunities nowadays. Yeah.
Jin Hong?
Yeah.
It's Josh.
Yeah.
Hey, we've got a question in the chat room here.
Go ahead.
And then I also just wanted to check in with timing. It's now 11:30, just to let you be aware. And I know when you get started, you can roll. So I've been taking some copious notes here. We do have a question from one of our audience members. And the question is, can H-1B visa holders start a self-employed business?
Yeah, you can do it. Yeah, Schedule C is fine. Don't go register S Corp or anything. Just be conservative, be quiet. Just as a Schedule C, I'm just gonna do something. Even I'm not making money, but it's my intention. Nobody will ask you. And then when you go do green card, nobody will check that. They don't ask you tax credit or anything. Yeah, it's totally fine.
Thank you.
Mm-hmm.
Other questions? I know we've gone through a lot today.
Mm-hmm.
We're going to wrap up here pretty soon.
Yeah, it's really exciting. If you're okay, stay with it. But if you have something to go, feel free. I think I do want to go through these slides. I think these are very important one in terms of putting the whole plan together. Would that be okay?
Yeah, keep going. For whoever wants to drop off and you have things to do, feel free to disconnect. If you want to stay on for another, I'd say maybe 15 more minutes, we're gonna be on. We've got another question here. Is C Corp better than an LLC? You haven't spoken about an LLC. Can you let us know if a C Corp is better than an LLC? It's
all about the context, about your goal. Like, what do you want? So LLCs are great for asset protection. So if you want to, protect your asset, and also LLCs are good if you don't have to operate the LLC. Once you operate, you need to pay salary, so it's going to be a active operation. So the best is to use S Corp so that you can pay yourself a reasonable salary and you don't have to pay so much social security tax. So LLCs are best for holding assets, protecting your assets, and then make it a passive. So if you're real estate, you use the LLC to hold the assets, and then it's a passive entity, so that your income is not going to be taxed at the ordinary income level. So it's going to be tax dividend, capital gain tax. So yeah, LLCs are great, but LLCs are not for attracting investors and becoming public companies. Yeah, so usually you can start, and the beauty of LLC is it's very flexible. So you can register an LLC, and then you can choose file the form 10 forgot. So just to file the S Corp election and be an S Corp. if it becomes your operation business. Okay. Now, if you're losing money, it does not matter. So the LLC is all fine. Yeah. Good question.
Thank you.
Any other questions?
Anyone else?
So we talk about the Roth, talk about the 401k, right? So the 401k, a beauty is you can put 401k there so that you don't have to pay tax now, and the money is growing, and growing, and you don't have to pay tax for the growth. But remember, when you retire, when you take this money out, you have to pay tax. Now, if you retire, you expect you just, Social Security plus this a little bit of 401k, you probably don't have much tax to pay, so don't worry about that. But some of you are doing really well, after you retire, your income will still be, coming, 200,000, 300,000. So the way you could do to create some tax-free money in retirement is, hey, let's say there's a year you will take some time off. You will borrow money from your 401k, or you have other income from your rent, and now you're building a business and you have no income this year, okay? Now you can convert some income to Roth IRA, and you could probably, if it's below the threshold, you don't pay tax. If it's still low, it's at the 50%, at the 10% threshold, you pay a little bit of tax, okay? And then when it grows in the future, you don't have to pay tax when you use the money, okay? Or when you retire, when you retire the first few years, you don't have income, and you still have some saving to live on, or you can, take some money, Social Security, whatever you have, and you convert some money into your 401k, into a Roth IRA. So that's a good strategy to do it. So converting Roth IRA. So in conclusion, tax are very complicated, and we can use all kinds of strategies, right? And I myself I'm a generalist. So I look at the big picture for you and make sure, if I see you qualify the premium financing, I'll tell you, and then we will find people like Josh. Okay, let's look at, if you qualify for the premium financing, and then we design something, okay? Or if you are ready for captive insurance, again, we will work with a captive insurance strategist. We put these together. So it's like a doctor, you have a family doctor, and then you have the specialist to implement. So that's how we work. And we are 100% digital, paperless, global, and virtual. Okay, we use technology to the maximum. So we meet on Zoom nowadays, and then we share files with Dropbox. So the way it works is we first meet on Zoom, have a discovery meeting. Where you're going, mostly ask you where you're going, where you are, where you're going, and then really create a plan and then review it. And then we implement over time, and then we maintain, adjust, and comply. And then we accomplish your goals. Now, are we a good fit to work together? So the way we are, one is we are technology driven. You have to be comfortable with technology, download a Dropbox app and scan the document and save in the Dropbox like that, and use Zoom, and then price that fit. So we are very flexible. So if you're a startup, you're a promising startup, we can take stocks as well, or combination of stocks and cash. And really the most important part is partnership. As we said, the most important part of tax and financial planning is the story, is your context, is your future. So you know your story. You are the author of your story. So we must have you involved. So we will work with you, okay? So that will achieve the most benefit for you. So we have to be a true partnership. So it has to be interactive and collaborative, okay? So that's very, very important. I always say there are 3 types of accountants. One type of accountants, and that's about 80% probably, are very much rule-based, and I call them actually IRS agent. They're not your accountant. Okay, if you have this kind of accountant, they're very much fear-based, very much scarcity-based. They just, I say they work for the IRS. So they're not going to create value for you. They're going to just make you comply, and very, very conservative. So another type of accountant is they know the secret. They know the secret of tax planning is the story, is the context, is your future. But they don't tell you that so that they can charge you more. They say, look, I saved you, $100,000 tax. I'm going to charge you $20,000. So that's another type of it. So for me, I believe education is important. You need to understand, and I believe you can understand through this kind of education. We're doing it every month. Every time you come, and I really appreciate it. There was one gentleman, I think David. Are you here, David? Every time I do, and he always come, and I said, are you tired of hearing me the same thing? He said, every time I learn something. So I really appreciate it. Okay, so that's how it works. We learn, and every time you get something, you're conscious, like, okay, ding, ding, and then you think about ways, and you come and talk to me, make appointment. This is very, very important. I believe in education, and believe in collaboration, communication, just talking through. Once you become a client, I always encourage you, put on my calendar, on my website, at least once a quarter, at least, and we talk. Even if you have nothing to talk, let's talk. Who knows? Great ideas come. Okay, and then another part is very important is integrity. And on my website, you can see we talk about integrity in 2 ways: design integrity and implementation integrity. Okay, so everything we do is documented. Everything is documented. We are doing it as if we will be audited. Okay, that's how we do it. Okay, so if you are act with us, thank you, and you can make the best way to talk to me is just go to my website and just schedule a time. Great, thank you very much. So now we are open to questions. Feel free to open your mic. We don't have many people. We have 21 people, so feel free to open your mic.